Welcome back to Lady Africa Forex YouTube channel. As a Forex trader, if you open the chart, how do you determine the direction of the market? You will agree with me, to determine the direction of the market, you have to do market analysis using the market structure. In this video, you will learn how to do market analysis using the highs, the lows, the ranges. That is, using the market structure. So, the market structure will show you areas of price movements, which are represented by moves that push the price high or low and moves that correct the price. So why is this important to you as a Forex trader? It's because you are going to see the market sentiments. You are going to make decisions regarding to whether to take the trade or to exit existing positions or to add more positions to your existing trades. So how do you do market analysis? First of all, you want to check if the market is coming from a high price point or if it's coming from a low price point. So the first thing you do when you open the chart, mark your highs, mark your lows. And then later on, as the market moves and you've marked all your points of interest, the market might transition. So check for transition of the market cycle to look for more opportunities to trade. So I have an example here of an uptrend market structure. So when you open your chart, you might see an uptrend market structure. So why is it an uptrend market structure? Because it will show you a bullish market and price is moving upward. So the first thing you need to do as a trader is to identify where is the price coming from. Is it coming from a low price point or is it coming from a high price point? So with this example, let's see where the market is coming from. It's coming from a low price point here and it's moving higher and higher and higher. Of course, the market will not go in a linear fashion such that it will just move from low price point to high price point in a direct manner, but it will go high in stages. So it will go high, form a high, get corrected during pullbacks, then other impulsive moves will push the price high again, get corrected, form higher lows, so on and so forth. So in the process, as the impulsive moves push the price higher to higher highs, as a Forex trader, you're looking for opportunities to buy. Remember, in a bullish market, we buy. So you're looking for opportunities to buy. You're looking for opportunities to get your trades at discounted areas. So you're looking for points of interest. So here our market comes from the low and then it pushes high and forms a high here. Then what happens? Price is pulled back, corrected, and forms a higher low. Why do we call it a higher low? It's because this price point here is higher than the low where the price came from. However, it's also lower than the high because price came from low, pushed to a high, got corrected and formed a higher low. Then what happened next? Price pushed forward to form another high. And this other high is higher than the previous high, the first high that we saw here. So what happens? This is an area of interest because it has formed a higher high, compared to the first high. So we label it higher high. After that, what happens? Price pulls back again to a lower price point and forms a lower high. So what does this tell you as a trader? It tells you now it's time to look at your points of interest. It's time to look for entry opportunities to buy at discounted areas. Remember, when you buy at discounted areas, you're able to make profits. So if this now is your point of interest, you are waiting for your price to pull back from the higher high and form a higher low. So once price touches your higher low, your point of interest, what are you doing? You're looking to buy. So regarding entries, remember we said every strategy has rules. Every strategy has confirmatory candlestick patterns that as a trader you're waiting for. You wait for the candlestick pattern to confirm your entry before you go. So there you buy at discounted areas, and then what happens next? The price will push high to form another higher high. So if you had made an entry here, and for example your targets for the day was 50 pips, so by the time this price moves from this higher low to the next point of interest, higher high, probably you've collected your 50 pips, you've achieved your targets, it's time to exit. So when the market has pushed the price from this price point here, from higher low to form another higher high, then as a trader you expect a pullback, you expect a correction. So this is when you decide, you have another decision to make, whether to exit that entry, which maybe you achieved your targets for the day, or you want the price to pull back again and get another opportunity to buy and add another position to your existing trade. Or if you want to take partial profits, remember in my previous video I talked about taking partial profits. You want to take your first profit here at this higher high because it's your point of interest. So you're waiting for it to pull back and the market to push the price again high, and then once you attain your ratio, 1-to-3 ratio or 1-to-1 ratio, you start taking your profits. So again, this market structure is going to help you decide at what points are you taking your profits and at what points are you taking your trades at discounted areas. So that is the importance of analyzing the market using the market structure, because it shows you your points of interest, where to enter the trade, where to take your partial profits, and where to exit the trade. So you can also analyze this market using a trend line. So let me show you an example of a trend line. So another way to analyze this market structure is by using a trend line. And a trend line is an indicator that can make your life easy when you're analyzing the direction of the market. So what you do with the trend line, you pick 2 price points. Let's say this is the first price point you'll pick here, and then you pick another price point, let's say here, and then you draw a line. That line will cut across. So as the market is moving upwards, price is pushing higher and higher, the price will definitely come and touch your trend line during the pullbacks. So what you're doing is you're waiting for the pullbacks. Let's say, for example, the price has started here. You can see it pushed high from low to high, then it pulled back. There you know what you're supposed to do. You're just looking for your confirmatory candlestick pattern to enter a trade. So you enter your first trade there. What happens? Price will push again higher. Now here, the first high you will have labeled there high, then price pushed, pulled back lower, then pushed higher and formed a second high, which now we'll call it higher high, because this price point has taken out the first high. So now it's called a higher high. What happens next? Price will pull back again and then push higher to another higher high. That's another higher high. So what happens again? Price will pull back. All the while, when the price is pulling back towards your trend line, you're looking for trade entry opportunities. All you need to look at is the candlestick pattern, and as long as the candles don't break the trend line, they don't close below the trend line, you still have your uptrend market structure intact. What do? You just look for a confirmatory candlestick pattern and enter the trade off your trend line. So price will come, bounce off your trend line and push again higher to another higher high. So you see, the trend line makes your life easier. So you just take 2 price points, draw a line, and then wait for the price to touch your trend line, bounce off, enter your trade, collect your pips for the day. So that is how you analyze the market structure using a trend line. And another indicator also that can make your life easy is using moving averages. So what happens during moving averages? All you do is select a moving average and tailor it according to your need. It could be 20 EMA. You could use exponential moving average, or you could use a smooth moving average. And the exponential moving averages, you can change it, customize it to either 50 EMA or 20 EMA, 100 EMA or 200 EMA. The concept is the same with the trend line. What will price do? The price will come and bounce off your EMA. So your EMA sort of works like a trend line. And you will see from this chart here, price is bouncing off the EMA, giving you entry opportunities. So once you have your EMA there, what do? Again, identify where price is coming from. Is it coming from a low or is it coming from a high? So if it's coming from a low, you know this is an uptrend market structure. So with this EMA, it has enabled us to identify areas where the price is bouncing off our points of interest. So this is our first point of interest. This is our second point of interest, so on and so forth. So what do? You wait for the price which has come from a low to form a high. Then when it comes back down, you prepare to enter trades at discounted areas. Then price will push all the way to another higher high, which takes out the first high. So what happens? What do you do when your price reaches the highest price point at that point? You prepare to exit. Remember, with your strategy, you also have your exit rules, your candlestick patterns that tells you it's time to exit. Or prepare to take your partial profits, wait for the price to pull back to your second point of interest and add more positions here. Then continue trading until you achieve your targets. So with the EMA, what are you looking for? You're looking for the candlestick patterns that shifts the price back to the uptrend. Remember, when the price was pulling back, it will come. Sometimes it will bounce off the EMA without necessarily crossing it, but sometimes it will cross with a few candlesticks and then close back inside. For example, if you look at this first point of interest here, there are like three candles that have opened and closed below the EMA, but the fourth candle here pushed the price back inside the EMA. So if the candlestick patterns have broken or violated the EMA, it should not go beyond 3, maximum 3. The fourth or the fifth, actually the fourth should close back inside to indicate that we are continuing with the uptrend, price is pushing higher. But if the fourth candle closes below the EMA, then that has violated. You wait and see whether the trend has changed and has transitioned from a buying cycle to a selling cycle. So basically that's it with an uptrend market structure. Remember, when you open your chart, you're looking for where is the price point at that particular time. If it's coming from a low, you start identifying your points of interest, your discounted areas, and you enter the trade. Now that's it with an uptrend market structure. Let's now look at a downtrend market structure. So the principles are the same. First thing you need to do as a trader is determine the direction of the market. Where is the price coming from? Is it coming from a high price point, or is it coming from a low price point? So with the downtrend, you can clearly see price is coming from a high price point. Let's check it out here. So this is where price is coming from the high, and it's pushing lower and lower and lower and lower. So that tells you as a trader that this is a downtrend market structure. So what happens during a downtrend market structure? We are looking to sell. We are looking for points of interest. We are looking for premium areas. We want to sell at premium areas so that we can maximize our profits for the day. So let's go. This is the high. Then price moved from a high price point here to a low price point. Then what happened here? Price consolidated a bit for some time, then pushed lower again and formed a lower low. Let me use a different color. Let me use black. Yeah. So price has come from high, pushed lower and formed this low. Then price consolidated here a bit, then pushed lower again. You can see the impulsive moves that push the market. So price has been pushed again lower than the first low. So the second low here, we call it a lower low. Then definitely price has to correct. It will not move in a linear fashion all the way down. It has to correct. So pullbacks are the price correction. So when the price pulls back, it forms a lower high. Why do we call it lower high? Because it's a high that is lower than the first high. So this is high and then went low, pushed lower, then corrected to a high, and then now it will push lower. So the price points are moving in stages. Now it has pulled back to form a lower high. What does this tell you as a trader? It's time to sell, and you are going to sell at premium prices, because if you sold here where the price is low, you'll not make much profit. But if you wait for the price to pull back, to correct to a lower high, you're maximizing your profits, because now you're going to sell at premium areas. So this is your point of interest. This is where you enter your trades. This is where you sell, because we are in a selling cycle. We are just looking for opportunities to sell. So you sold here, price will push lower, and it's the impulsive moves that push the prices. So impulsive moves have pushed the price lower. So if your targets here was 100 pips, maybe this market session you wanted to achieve 100 pips, in case during the impulsive moves you have already collected your 100 pips, what do? Stick to your rules for the day. You exit. So once the price reach this lower low, you start with your exit strategies. That's when exit strategy comes to play. You exit the trade, or you take partial profits. So now you're going to take profit 1 and wait for another premium zone to enter another trade and do more profits. Okay, so here we are. Price has pushed lower. Now it has formed another lower low. As a trader, you expect the price to correct and form a lower high, your second point of interest, where you sell again, collect more pips until the price forms another lower low, and then you will go all the way until you achieve your target. And this market might push lower and lower until the lowest price of the day is achieved. So you either exit upon reaching your targets, or you swing it the whole day until the lowest price has been reached, and then you exit the trade. And just like the uptrend, also you can use the same principles with the downtrend, where you use a trend line to make your life easy, because you know what you're looking for. You're looking to sell. So with the downtrend, you just draw a trend line. You look for the direction of the market and draw a trend line. So this is a downtrend market. What do? Let's draw a trend line by touching 2 price points. So this is my first price point here, and this is my second price point. So what do? I just extend the trend line. Okay, you extend your trend line, and there you are. You have your trend line. So the first thing you do, identify the direction of the market. So here we can see the market has come from a high price point here. Let me draw a high price point. Let me use red. Okay, this is our high. Market is coming from a high price point and is pushing the prices lower and lower and lower. So what do you do next? You make a decision. Let me draw a trend line so that it can make my life easier. So this is my first price point and my second price point, where the trend line is going to touch. So once I touch those 2 price points, I extend the trend line. What do I expect now after I've drawn my trend line? Let's say, for example, my market is here. It's now pushing. We are at this red candle. It's pushing lower and lower. I expect the price to correct. So price has come to a lower low. Now you understand why we are calling it a lower low, because we have another low here. We have a low here, and this has pushed lower. Now it's a lower low. So I expect the price to correct and give me premium areas. So price has corrected, and that's now my point of interest. That's where I want to sell at premium prices to maximize my profits. So price has corrected, it has touched my trend line, and it did not break. If you look at the candlestick patterns there, it did not break my trend line. So this green candlestick opened and closed below the trend line, and the red candlestick opened and closed below the trend line. So that's my entry there. I sell, and then I collect my pips all the way to this low. Definitely this low is going to be a lower low, because it's lower than the previous lower low. And if I've achieved my targets here, I will exit the trade, or I will wait for the trend line to be broken. You can see here this trend line has been broken. How many candles have closed and opened and closed above the trend line? Let's count. 1, 2, 3, 4, 5. So definitely that market structure has been broken. We are no longer selling. You exit the trade. If it had bounced back and moved lower, then it's another opportunity to sell. So you can see the trend line has made my life easier. It has helped my analysis more efficient. Let's now look at the EMA, the moving average. So just like we did with the EMA on the uptrend, we are going to do the same with the downtrend. Draw a moving average. These are indicators you can find on the platform. You just go and look for them at the platform. You'll find different moving averages, whether it's smooth moving average or exponential moving average, and then you pick either 20, 50, 100 or 200. I personally prefer using 50 because it is flexible to the price action. So the chart, once you set the moving average, the chart will just show. As the price is moving, it will come and bounce off your moving average. So all you need to do is look for trade entry opportunities. So here also price came from the high. It's coming from a high price point and it's moving. It's pushing the market lower and lower and lower. What do I do as a trader? Identify my points of interest, because that's where I'm going to sell at premium prices. And the EMA has made my life easy. So this is my first point of interest here. This is my first point of interest here. I look to sell. Then price has formed a lower low here and pulled back all the way to the EMA 50. My second point of interest here, I look to sell. Then market will push the price lower and lower and form another lower low. Then pull back all the way to the EMA 50. Yeah, so price has pulled back all the way to the EMA 50 and given me another opportunity. This is the third one. The third opportunity to sell at premium prices. Until a point where now price has changed. This green candle has closed above the EMA. So I'll wait to see whether the following candles will continue above the 50 EMA, or the price will come and close back inside. Then I'll make a decision whether I'm still buying or it's time to end my trading session. So we've seen uptrend market structure. We've seen downtrend market structure. Let's see what happens when there is no clear distinction as to whether the market is going up or down. What do you do? So sometimes you can open a chart and find a ranging market or a sideways market. How do you know it's a ranging market? Is because this chart has no distinct direction of the price. You cannot find any higher highs, nor can you find any lower highs. So this is where price is fluctuating within a tight range. What do you do as a trader? You just mark your highs and your lows. So let's mark our highs and lows here. So this is the highest price point during this session, and let's mark the lowest price point during this session. So price is just ranging here. Doesn't form a higher high, it doesn't form a lower low. It's just bouncing between the two areas, the high and the low. So this is the high and this is the low. What decisions do you make as a trader when you see a ranging market? You wait for a breakout, because eventually the price will break out of this area. So it will either break out to the higher side or break out to the lower side. So it might either break out to the higher side or break out to the lower side. So once the price breaks out of this range, you wait for a retest, then start looking for opportunities either to buy or to sell. So let me give you an example of a breakout structure. There's a breakout structure here. Yes. So you open a chart, you find yourself in a sideways market, you draw your line and wait. So here this is a ranging market. That's the high and that's the low. So what did we do as traders? We waited for the price to break out. So clearly we can see the price broke out to the lowest point, to a low, and started a new direction. So price broke out to the low, started a new direction, and formed a lower low. Remember here, this was our high and this was our low. Yeah, so price has broken out from the range and formed a lower low. So what are we looking for? Opportunities to sell, and we only sell at premium prices. We only sell after price correction at the end of the pullback. So here this price has come all the way to the low and pulled back. So this is now our point of interest. This is where we are going to sell, because we are going to maximize our profits as the price broke out and retested the area and gave you a premium package. Same with the other side of the story, where the market decided to break out to the high. Instead of breaking out to the low, the market decides to break out to the high. So when the market breaks out to the high, what do? You wait for a retest, because this market will break out and form a higher high. It will form a higher high. Remember, this was our high. Market has broken out. Price has pushed higher to form a higher high. So what do? We wait for a retest. There, this is our point of interest. We buy at discounted area and make our profits. So that's what you do. That's how you analyze arranging market structure. Just draw the high, draw the low, wait for market to break out of that tight range, then wait for a retest. If it breaks out to the higher side, wait for a discounted price to buy. If it breaks out to the lower side, wait for premium area to sell, and you maximize your profits. So basically, that's how you do market analysis. So we've seen how to do market analysis using the market structure. We've done an analysis on an uptrend market structure, downtrend market structure, and sideways market structure. We know as a trader, when you open the chart, the first thing you need to do is determine the direction of the market, and also look at where the price is coming from. Is it coming from the high? Is it coming from the low? Then you identify your highs and your lows as the market structure forms. Then you're able to identify your points of interest. You're able to identify your entry points, and you're able to execute the trades according to your trading structure rules. At the end of the day, you want to become a profitable trader. At the end of the day, remember, before you start trading, you have to do market analysis using the market structure. So let's hope you've learned something. Don't forget to subscribe, and see you in the next video.